Welcome to the Changing Tides of 2022. I'm Kathy Fettke, co-founder of RealWealth. I'm so happy you could be here to join me. I'm going to start with this disclaimer that I'll be sharing my ideas today. I just asking that you don't sue me for sharing my thoughts. Always do your own due diligence and know that I try my best, but I actually cannot predict the future. All right, so the 2022 puzzle is what we're going to try to figure out today. There's a lot of moving parts, a lot of pieces on the table, and if we could just look at each one, maybe we'll be able to figure it out together. I want to start with back in 2013, I was asked to debate Robert Shiller of the Case-Shiller Index, also a Pulitzer Prize award-winning economist, an expert in housing. So real scary for me. It was his first debate and certainly mine. His side was that it was a dangerous time to be buying real estate, and my side was it was the best time ever. Now, if you just looked at the data, you would see prices just going down, down, down at that time. But how do you interpret that data? What I was seeing was low prices and high cash flow and an opportunity to cash flow. And if prices went up, well, that would be wonderful, but at least you had really amazing cash flow. But it also seemed like eventually prices would go up. And I think what he was looking at was just this down market and would it ever come back? So two very different perspectives. But what's confusing is for the listener, right? Millions of people probably watched this debate and probably thought it was a really bad time to buy real estate. Although at the end of the debate, he did agree with me. So hopefully it encouraged people to get in, because if they did, well, I think we can all agree they'd be sitting pretty happy today. So the question is, who do you trust? Who do you listen to when it comes to making financial decisions? And what we found at RealWealth is that we have this asset of our teams, boots on the street, all across the country, some of the best real estate investors out there who know their markets inside and out, better than, in my opinion, a data analyst or a journalist who doesn't really know real estate. So I've really come to rely on our teams to give me information I need to really get that real-time data of what's going on out there. And in 2020, when everybody was confused and the headlines were saying, there's going to be millions of foreclosures. I think that was really one of the headlines, that 5 million foreclosures coming by the end of the year, and massive evictions. And of course, it seemed that way, right? Because people couldn't work. So how could they pay their mortgage? But then we would call our teams. And if you were a RealWealth member, you know that we had somebody from a different market do a webinar every single day in March and April and June and July of 2020, because we wanted that real-time information and to share it with you, our members, of what was really going on out there. And what they were telling us was the exact opposite of what the news was saying. They were saying, no, everybody's paying their rent, and we have lowest vacancies ever, and rents are actually going up, and there's a wait list. So we were getting this information before it became headline news. And of course, now we know today that shortly after, there was a massive housing boom. But we could see that coming because of these teams, and they are here for you as well. We still do those webinars. We try to keep you updated as much as possible on what's going on out there. So what I try to do here at RealWealth is interpret headlines. I was a newscaster, news reporter for many years. And after that interview with Robert Shiller, that got me a whole bunch more interviews, helping people really understand what was going out there from that boots on the street perspective. And that's what we're going to be doing today, just taking headlines and trying to dissect them and see what's underneath it all. So this is really the current picture that we're seeing. 2021 had massive US economic growth, just a massive bounce back from 2020. GDP up 7%. Really, really impressive comeback in the US. Low unemployment. I mean, 2020 was terrifying. Look at the job losses there on the right. You could see nothing in our lifetimes came close. But then what a quick recovery. So many people, if you remember, were saying, is it going to be a V recovery, a W, an L? There are all kinds of people talking about what was going to happen, but that's even more than a V. I don't even know what that shape is. It is a quick recovery is what that is. In fact, such a recovery that we have too many jobs today. There were 4.6 million more job openings than unemployed workers in December, and job openings totaling nearly 11 million. So that's incredible. We were talking about, so many people being unemployed. I think it was over 20 million. And then look at today, just opposite problem. We need people to work. And then same thing, stock market gains. Boy, I hope some of you bought stocks when they went down in 2020, because look at that comeback. Just amazing. We bought a few. We're not really stock people, but it just kind of made sense. And they've done really well, but I wish I'd bought more. And same thing with home prices, just incredible. Just amazing comeback. Look at the home prices, kind of scary, up 19% just this last year. And Zillow's saying it's going to continue. Zillow's growth forecast 17%. So they're not seeing any slowdown, and that's really interesting. So what's going on? Well, what we know is demographics. That big hump right there, the yellow group, 21 to 38, is the millennials. And look at that, 82 million of them. There's a whole bunch of them. And many of them were born about the same time. Oddly enough, I have a daughter. My oldest daughter is in that hump. She's 29, turning 30. And that is the largest group of of millennials are 29, turning 30. And 32, 33, 34, that's the average first-time home buyer age. So that means that what we have ahead of us is a massive group of millennials ready to buy homes. So at a time when so many forecasters were wrong and headlines were saying 5 million foreclosures coming, so we weren't building, we weren't preparing, and yet there's this wave, this tsunami of home buyers just when the inventory wasn't there and wasn't being built. So it's a big miss by economists, by forecasters, by builders, by the government, that these people are going to need housing. And there was always this misnomer that millennials were somehow different than other generations, and they weren't getting married and having babies and moving to the suburbs, and not moving, to the suburbs. But we know that's not true. They were just young when they were being criticized. If the oldest millennial is 38 today, it was 10 years ago that people were saying, oh, they're just lazy and not doing anything, sleeping on their parents' couch. Well, they were in their 20s, and some were just teenagers, So I don't know about you, but I wasn't looking to buy a house at 22. So 10 years ago, they weren't ready, and people were acting like they were never going to, but they are now. Millennials are getting married. They're having pets, dogs and cats, and not necessarily wanting to live in an apartment downtown. They want to be like anybody else, have the white picket fence, the home, the yard for their pets and their children. And, and that's what we're seeing. Millennials are buying homes, and there's simply not enough for them. But it's a very educated generation, a very tech savvy generation. Many are able to work anywhere. So they're getting creative, and millennials tend to like to do things their way. So if they can work anywhere, why wouldn't they go somewhere that they could afford a bigger house? So this brings us to the slide where we're really seeing inventory disappearing as more and more buyers come to the table. They're capable, they have strong FICO scores, good jobs, and plenty of savings, and they're buying. So as a result, you can see that little green line at the bottom, January and February, very, very low inventory compared to prior years, less than a third of the inventory we've had in the past. So this is, of course, what's driving prices up. Will it stop? Well, Zillow doesn't think so. And a lot of other people don't think so either. And with that, if you can't afford to buy, and many people can't because now interest rates are going up and home prices are up, you're going to be renting. And that's why we're seeing massive increases in rents. This is not healthy, not sustainable. Some markets, this is just an average, but some markets were way beyond that, like Miami, rents up 38%. Can you imagine? That's a tough pill to swallow. And again, it's not healthy for anyone to have to deal with this kind of change in pricing just to have shelter, a basic need. Rent versus owning. Now, there's some places where it's still cheaper to rent than own, but you can see in Los Angeles, it's still more expensive to own than rent. But in other places like Nashville and Las Vegas and Minneapolis, Phoenix, Raleigh, and most of the markets that we're in at RealWealth, it's about the same. It's not that different. In some cases, it's actually cheaper to own than rent. So those are the markets that we like to be in because it's more affordable for everybody. So will new supply come in and help? Well, the answer is yes. New home construction is soaring, 22%. Builders are building again. New home construction starts jumped 6.8% in February, 22% higher than last year. So that's good news. And it's the same for apartments. 2022 will be a record year for apartment construction. You can see there, it's coming back. We're doing better. However, will it be enough? You can see here, new home lot supply index just tanking, and United States new home community count. Look at that. This is the problem with this big influx of home buyers and household formations. There is building happening and it's trying to catch up, but not fast enough to slow down prices. And then you've got to add to it supply chain issues that are delaying some of these new homes. I mean, we're certainly experiencing it at RealWealth. So when will that subside? We don't know. It's not looking like it's going to subside anytime soon, especially now with this horrible war that we're seeing. But COVID shutdowns, we know that if one person tested positive, even if they felt fine, it would shut down the entire job site for 2 weeks. And then the next person comes to work and bam, it's shut down again. So all over the world, it's not a US problem. It's an international problem. Many factories were just shut down and demand is so high that these shipping containers are just sitting out there in the ocean and not getting unloaded because, again, same problem everywhere. So then you add this crime against humanity, this just horrible situation in Ukraine, and God bless those people there. But it is also going to be affecting the supply chain and causing more inflation, as we're seeing with oil prices, gas prices in Europe, certainly, and food prices will probably continue to rise. So all this adds up to U.S. inflation, the highest in 40 years, with no let up in sight. That's U.S. News and World Report. We know that it was at 7%, and some people are saying it could get up to 10% in the next few months, maybe even higher than that. So how do you slow it down? Well, the Federal Reserve is the banking system that is supposed to be controlling things like this through interest rates. So if interest rates are low, that encourages people to spend money. And of course, you can afford to buy more things if interest rates are low. And it fuels the economy. That's how you get an economy going. So when COVID hit, the Fed lowered rates and really stimulated the economy to get going, and it worked. But they may have overstimulated. They may have lowered rates too low and also created too much money. There's trillions and trillions and trillions of dollars floating around. I believe the amount of currency that was added was like a third or half of the currency in existence. I mean, just unprecedented, massive amounts of money circulating, which again causes more inflation. I like to describe it like the Monopoly game. If you've got a board of Monopoly, you've got, the board in front of you, and there's a certain amount of assets on there. There's apartments and houses and so forth. And you've got your banker, and you get money from the bank. And then all of a sudden the bank brings in another box of money and passes it around, and people get, free money, and you're going to spend it. And yet there's the same amount of assets on the table. So people have more money to spend on it. Doesn't mean that the assets actually went up in value. It just means that there was more dollars circulating that could be spent on it. And that's kind of like a devaluation of the dollar, not necessarily an increase in the value of the asset, if that makes sense. So that's what we're seeing, just more money circulating, and it's landing in real estate. So to slow that down, you may recall that originally the Fed said, oh, it's just transitory. Well, they're not saying that anymore at all. They're concerned. They definitely overreacted. Too much stimulus over the last just 2 years. It was just 2 years ago that the virus hit, and yet the money supply, went up 50%. So a lot has happened in 2 years in our financial industry. So the Fed is now saying, oops, yep, we overshot. Okay, we're going to correct that. And this is what I meant by the changing of the tides. There was massive stimulus, and now the Fed is taking that away slowly. So it's like putting out the punch bowl and then saying, okay, you're all drunk enough, I'm taking it away, and everybody's going to sober up now. And they don't like that. They don't want the party to end. And that's what we're seeing, but it needs to. It needs to. There was too much stimulus, too much money floating, driving prices up way too much. That money creation is a secret tax. People don't understand it's a tax, and they're paying for it through inflation. So now the Fed's going to reverse policy. The tides are changing. They're going to raise interest rates and slow things down. And that's why we need to be aware, like, how is that going to affect us in real estate? Now, what we know that in past rate hikes, it has often ended up in recession. And I'm just I don't know if you can see my mouse, but you can see rate hikes here in the 70s, and then, recession. And then things corrected, they lowered rates, and then probably the economy got booming. So they had to raise rates to slow it down, recession. Then they had to raise them again, recession. You can see here, I'm not sure what happened here, but oftentimes these are the recessions, these lines, and you can see interest rates going up right beforehand. So it's an interesting pattern. We've been at zero rates since the Great Recession of 2008. And then they started raising rates right about 2016, you can see, and raise right around 2018. We started to really feel it in the housing market when it got about to 2.5%. And what I mean by rates, I just want to be really clear for those who are unfamiliar with this. I'm talking about the Federal Reserve's overnight lending rate to banks. So the Federal Reserve lends to banks, they lend it to you. If the banks are borrowing it at 0%, they can lend it to you at 3% because they want to make the margin. But if they have to pay 1%, well, then you pay 4%. So you could see as they started to raise, well, then banks lend it out to us for more. And that's kind of how it works. So right around then is when we started to feel it in the housing market. And then, of course, the coronavirus hit and went back down to zero again to fuel economic activity. And it worked. What we're seeing is that just even talking about raising rates, which the Fed has been doing for a few months, talking about it and started in March, it's already started to affect the economy, in that projections for GDP are slowing. They thought that this was going to be another robust year, and it will be, but just not as much as they thought because now rates are going up. But back in 2018, these were the kind of shows I was on. There was a bit of a housing slump, especially in new homes in December of 2018. And then you might recall that President Trump fought with Jerome Powell and said, you need to reverse course, stop raising rates, in fact, do the other thing. And Jerome Powell said no. And then I don't know what happened behind the scenes, but the next thing you knew, we started to see rates go down again. So Powell won that battle. But, here we are. And what do we do? What do we do now that we know that things are changing again? There was massive stimulus, all kinds of support for housing, low interest rates, lots of money floating around. And now that's changing, where they want to slow things down, make it more expensive to borrow money, and therefore fewer people can afford to buy homes. So, one question people have is how high can they even raise interest rates? Because it affects payments on the national debt. And the national debt, the federal debt, is at $30 trillion. Just look at this slide. You can see the arrows show every time that the national debt doubled. And now at 30 trillion, like, it's really even hard to fathom how much money that is. It's really, really poor monetary policy, if you ask me. If you're borrowing that much money, you better have something to show for it. And I'm not sure we do. I hope we do, but where did it go? So $30 trillion in debt. Boy, if any of us borrowed that much, we may have different results. But anyway, where'd that money go? If interest rates go up too much, will the government be able to pay the interest on the debt? That's really the concern. And there's a cap to how much they can raise rates. So some people are saying, up 2.5%. I don't know. But these are the big stories you're going to see. What can the Fed do? They need to raise rates to slow down inflation, but can they? And how far can they go? So it seems that this is the new monetary policy. They're calling it modern monetary policy. Japan's been doing it for a while. It's basically money printing. It's like, you know what? I know how we'll pay the debt. We don't have to charge you all taxes. There's not enough taxes to pay for the debt. Like, you would have to take everybody's money, all their savings, and all, like, there's just no way to pay the debt. So a really nice solution is, we'll just print money. I mean, if you had a bunch of debt you couldn't pay, wouldn't you just want to have a money printing machine and just pay it that way? So that's what they're doing. And then when you look at this slide, this is the M1, this is the money supply. And you could see back in 1971, this wasn't really an issue, but that's when Nixon took us off the gold standard, which was a control of this type of thing. It was basically like, you can't print more money than we have in gold storage. But then Nixon thought, and they agreed, well, we want more money than we have in gold. So the dollar became the new gold standard, basically. And that's how oil is traded in US dollars, not gold today. And that's a big point of contention. The US has an advantage by being the international currency that oil is traded in. And that's kind of coming up today, where Putin is saying, no, I'm not going to do that. You can trade in rubles. And that's bringing up a lot of issues because, in fact, the US has had an advantage because of this. And there's other countries that would like to have that advantage. And Russia is fighting for it right now. It's going to be interesting to see how that plays out. But bottom line is, when we went off the gold standard and made the dollar the new gold standard, well, it's a lot easier to make dollars than gold because you just push a button. And over the last 2 years, look at how they pushed that button. It's unprecedented. It's hard to even look at. I don't even know how to interpret this slide, besides the fact that if you want to talk about a recovery or a strong economy, what you're really talking about is there's just a bunch of money that was printed and is circulating, and that's what's fueling things. And they don't want to stop. We know that gas prices have gone up, and look at the solution. Okay, we'll just print some more money and give it to you, and you can pay your gas with that, with a stimulus check. But then what people don't understand is it's just going to create more of the problem. It's going to create more inflation. The more you print, the more dollars are circulating, the more money is chasing the same stuff, the same assets, and it drives it up. So you can see in this slide, inflation is not new. We've been talking about it lately like it's new. It has certainly accelerated in 2021 and 22, but you can see that it's really been going on since we went off that gold standard in 1971. But mortgage rates don't necessarily follow what the Fed does. They follow what the 10-year Treasury does. You can see here the 10-year Treasury versus the 30-year mortgage rate, and they really follow each other. And it's basically a picture of what investors are doing. Investors buy the 10-year and 30-year mortgages, MBSs, mortgage-backed securities, when they're feeling fearful, when they want safety. But when they think that they're going to make money elsewhere, they go elsewhere. And then these 10-year treasuries and mortgage rates go up because in order to attract investors, it has to be a better deal. So they have to increase returns. So this is just a really good gauge of where rates might go and what investors are thinking. And this slide will tell you that, if you can see, because prices are going up for the 10-year and the mortgage rate, the yield, that means that investors are ditching them basically and buying other things, inflationary things, which is basically stocks and real estate and other investments that they think are inflationary, where they're going to make more money than on a 10-year or a 30-year. Because let's face it, if you're getting a 4% interest rate, well, the investor's not making much money on that. Same with a 10-year, it's low. Whereas if inflation is at 7%, people are going to go buy things that inflate at 7%. We see that real estate inflated at 19%. So why wouldn't you put your money there instead of the 10-year? So that's what we're seeing. Investors are thinking inflation is going to be here for a while. And that's kind of how I interpret that. We talk about, where will these interest rates end up? What we're looking at here is over the past, 40 years, interest rates have been on a trajectory down. Very, very interesting, which kind of shows again that investors are kind of looking at more inflationary things to invest in than mortgages. So the question is, how high will mortgages go? Well, based on this slide, maybe not that high. Maybe they're just going to kind of come back to where they were, like in the 5% range. Will they go back up to the 1980 levels? A lot of people don't think so, but who knows? We can't tell the future. From what I can see from the people I talk to, it may land around 5%. But again, nobody knows. What we do know is it's been a perfect storm out there for us real estate investors. And I just want to congratulate anyone here who's listening that if you took the risk and bought real estate over the past 10 years, you probably did pretty well because you could lock in a low interest rate, you could cash flow, you could flip it, you could live in it, and it's certainly gone up in value in almost everywhere in the country. So it's really been a good time to invest in real estate, but we also have to understand that the tides are changing. And it doesn't mean that you shouldn't swim or surf or go out in the water. You just need to understand that maybe the rules are going to change. Maybe like as a surfer, if you go out when the tide is going out, which is kind of now, it's like the money's going out of the market because they're tightening. The Fed is raising rates, which is sort of like a picture of the tides going out, the money's leaving the market. You're just going to surf differently than if the tide's coming in. For example, if the tide's going out, it might expose more rocks. You might have to be more careful about that than if it's high tide where the rocks are way below and you can't see it. It's just a little bit different time to be aware that some things might become more exposed than they were over the last 10 years. Again, uncharted territory because we've never been in a situation like this where the Fed has printed so much money and where the US has been in so much debt. So what do you do? Well, for me, this is what we're doing and this is what we've done. And I just want to share it with you, right or wrong. This is what we do. This is our story back in, we started investing in 97 and we did the house hacking thing. We bought a house and turned it into a fourplex and lived in one part of it and rented out the rest and basically kind of lived there for free. So that was just a great way to make money because that house increased in value every single year. We took some of the equity and it was about 2005 that I learned from Robert Kiyosaki that Texas was really booming with job growth, population growth, and yet home prices were so cheap. Cash flow was high. So guess what we paid for this house, isn't it? It's a beautiful house in Rockwall, Texas. We bought in 2006. And look at us. We were just little kids then. This house was $145,000, if you could imagine that. And it rented for about $1,500 a month. So it just made sense. And we bought a lot of them. We bought, I think it was 12 properties, because back then we could get 100% financing, if you can imagine that, and unlimited number of loans. Those were good times. But then just a couple of years later, the Great Recession hit, and all those people who got all those loans with no qualification, no money down, well, that didn't work out so well. So here's what we learned from all of that. Even during one of the worst housing crashes in the US, the worst since the Great Depression. We found that our members at RealWealth who listened to us and bought in Texas, they did really well during that time, because when people were losing their houses, they were kind of forced to rent. So they might have just turned around and rent the same house or the one next door, because they lost the one that they owned. So actually investors did really well if they were able to hold on to that property. So if you are able to buy a property where the rents cover your expenses and there's extra left over as cash flow, that will get you through hard times. The problem is when there's hard times, your tenant might not be doing so well. They might lose their job. And in good times, tenants can get sick or go through divorces, or just things happen where they might not be able to pay the rent and you have to evict them, or they have to leave and you have to get a new tenant and there's a downtime there. So having cash reserves is vital. So having a property where the rent covers the expenses is very important, the cash flow, and having enough cash set aside such that if it doesn't stay rented, you're going to be fine. You just treat it like a business. Every business should have cash reserves for tough times. And when you know you have that, then you don't stress out so much when things don't go well, because you planned for it. So we usually say have 6 to 12 months reserves set aside, meaning if you have a mortgage payment and taxes and insurance, you've got 12 months of that set aside, so that it's very unlikely your place would ever be not rented for 12 months, because all you have to do is lower rents. It should be able to get rented at some price. And then you've got the cash reserves to cover that, just like any good business would. And then never over leverage, because if prices do go down and you need to sell, you don't want to be underwater. So we recommend at least putting 20% down. You put 25% down, you're going to have an even better rate on your loan. But just, be careful about over leverage. I've seen some packages come across my desk where somebody wanted to do a syndication with a build out in, I don't know, Austin or something. And it was going to be 85% leverage on a new build. And no, we weren't going to do that. That was just too high leverage, especially for something risky like new construction. And then financing can disappear. We really learned that in 2009, that banks failed. When there's a bad recession, they can really get hurt. And in many cases, loans that you thought you had just disappeared. If you had a construction loan that ballooned after a year and you knew you had to get a new loan after that, or you had a bridge loan, if you went to go get that new loan, it might not have been there. And that's the market that we're in right now, where credit is coming out of the market. The tide is going out. It's not going to be as much credit as there was. So if you're in a short-term loan, you can't guarantee that there's going to be financing for you there when you need it. And Rich and I went through this personally. We bought 3 new construction homes in Tennessee in 2007 or something. And the homes were great price, but we didn't do a construction to perm loan. We just did straight construction, where once the home was built, we'd have to get a refinance and get a loan. But at that time, by the time the house was done, there were no loans to be had. Banks were failing left and right. And we were already over our limit. They changed the limit that investor loans from unlimited to 10. So when I first started investing, you could literally get as many as you wanted. I know people who had hundreds of investor loans through Fannie and Freddie, and then that changed overnight. So all of a sudden, best laid plans, that the loans weren't there. So I do prefer long-term financing whenever you can. It's just a safer way to go. And then, of course, the right market matters. We like to be in markets that are job friendly, that are landlord friendly. We've seen certain markets absolutely thrive through the last 2 years, and other ones, really be struggling. We know that Florida, Texas, Utah, these are areas where they have recovered their jobs. And if anything, I know Austin, Boise, these areas have more jobs than before the recession, before COVID. So just being in job-friendly markets is really important. And that's what we do at RealWealth, is look for those kinds of places. All right. So we'll just take a quick look at some of the markets that are performing pretty well. These are the top markets right now for entry-level buyers. And you can see you've got Indianapolis, Chicago, Cincinnati, Jacksonville, Charlotte, Raleigh, Salt Lake, Nashville, Detroit. This basically means that somebody who's a first-time buyer can still afford to buy in these markets. We kind of like that because that's not an overinflated market. That's still a good affordable market. The top entry-level markets that iBuyers are going into, that would be Phoenix, Charlotte, Jacksonville, Atlanta. So these are some areas where you're going to see a little bit more competition, where those iBuyers are. We hear that the investors are buying big in certain markets, and these would just be some of those markets where there's going to be a little bit more competition. This is one of the reasons we like an area like, say, Cincinnati, because it's not on the list. It's not the hot market list, so you could still get deals. That's not to say we don't like these markets. Jacksonville is a wonderful market. Charlotte, Atlanta, it's just more competitive. But thankfully at RealWealth, we've got really good partners, friends, friends at this point, property teams who have helped our investors buy property for over 10 years now. And they're loyal to us, so they're able to still find inventory in these hot markets. They try to stay buying things that are different than institutional buyers are getting. That might be a little bit higher price point or a little bit lower than what they're doing, or different markets, or maybe they need more work or something like that. Again, the fastest selling markets, these are the hot markets. You can see their average sales rate. Wow. So from just 1 year, look at the sales rate in these markets. It's just hot out there. There's just not very much inventory. That's why a lot of people are frustrated, because it's just not out there. But, again, our teams do their best to make sure we always have some inventory. But this is why people are getting outbid. The sales pace is so fast, and the inventory is so low. So I'm going to just leave it with, the most important thing to remember is that this all can be really frustrating, not knowing what's coming next, and not being able to find a deal, and cash flows going down. Cash flows are really, really low now. In fact, some of the markets we're in, there isn't cash flow. You're just break even, and that's frustrating to people. But I want to let you know that in a market like this, where investors overall, the ones who are dumping the 10-year and the MBS, they're going into more inflationary investments because they think there's going to be more inflation. The Fed thinks it's going to be more inflation. We're seeing it. And real estate is a great haven for that. It's a great place for you to be able to put your money, borrow money at low rates. I know rates are going up, but they're still historically low, and be able to lock those in for 30 years, buy an asset that sure seems like it's going to continue appreciating. Like Zillow thinks it's going to be double digits for the next couple of years, and rent's going up. So it's a hedge against inflation, especially when you use leverage. If you're borrowing money at 5%, but inflation's at 7%, that's a pretty good deal. That's a really good deal. But in spite of all of that, just remember that that real estate isn't what matters most usually, even though we put a lot of our attention to it and our jobs and money and all that. What's the why? What's behind that? And you can invest in that today. If it's having a date night with your spouse, or going on vacation with your kids. Rich and I would always make sure that we would have a weekend away individually with one kid. So I would take Krista to a mommy daughter camp, or Rich would take her to climbing, and just spend the weekend together, and carving that out in the schedule, because in the end, that matters most. That's what real wealth is, really making the things that matter most a priority. All right, I'll leave you with that and take some questions. So thank you again so much for joining me here. Let me see if I can see the questions. Oh, I can see them. One is, how long will it take for interest rate hikes to bring down sales prices? That's a good question. I actually do have a slide on that, and it depends on the market in most cases. So in certain areas where the affordability is still pretty strong, it's going to take a while. There are certain markets, and especially tech markets, where there's high, you've got people with high salaries living in affordable places. Let's just look at Austin. We have not put Austin on our list because we didn't really think it cash flow that well. But if you were looking for appreciation only and you bought in Austin, you made prices went up 50% last year. I mean, I wish I had a crystal ball that actually worked, because I have one, but I don't think I know how to use it, because I would have bought in Austin. But you know, who knew that that would happen? So the tech centers are really booming because you've got high paid people who still think Austin's cheap, right? It's not cheap for me. I'm not going to buy a property that doesn't cash flow. But if you're going as a homeowner or a renter, these are people with really good salaries that might have left San Francisco or New York, and they're looking at Austin like it's still cheap. And the same goes for the markets that we're in. Any market in Florida is still cheap, comparatively speaking, from the people, excuse me, leaving the high-priced markets. You also have employers who are really sick of high-priced markets, and some of the ways that businesses were treated over the last 2 years. Those businesses are moving to places like Texas and Florida, and anywhere where they can, you know, keep their businesses open. So, you know, it's just going to depend on the market. Interest rate hikes will be, certain markets will be less affected, and those are the ones that are still affordable. But again, I've said that before, and then you look at a place like San Francisco, it's never been affordable, and yet prices, they're having the same problem. You know, there's not enough inventory, and people are paying whatever. There's so much money circulating. There's trillions of dollars circulating, and it's finding its way to real estate. It's finding its way to the stock market. That is the bottom line. So there's plenty of people just paying cash. So sure, of course, interest rates are going to make a difference, but until all of the stimulus sort of settles down and finds its way to somewhere, it's going to be a crazy wild market. Zillow, as you saw in one of my earlier slides, is still expecting a really hot, robust market this year. I forget what it was on that slide, but in the double digits. And I would personally not count on that. I think that we're going to see home price appreciation slow down a bit. But when you're slowing down from 19%, which was the national rate last year, even if we got to 8% this year in appreciation, that's still historically good. So I don't think that we're going to see any kind of tumbling of home prices. I just think that we'll see a slowdown in price growth, which is very important and very necessary. So it's a good thing. It will create a more healthy market. Let's see, I'm going to come back on so I can, there, I'm back on. All right. So hi, everyone. So do you think the rapid new construction will impact lower rents significantly? I hope so. You know, it's investors should not be greedy. We should provide a great service to humanity. That's the way I see it. When rents are going up 50% like they did in 38% in Miami, that's not healthy. 25% in Phoenix. How is the average person supposed to feed their family with that? So investors really should be happy with 4% rent growth, in my opinion, something that goes along with inflation. If inflation is at 8%, that would be healthy than these runaway rent prices. So I hope that the new supply that's coming online will slow down rent growth. And I hope that it will slow down price growth. And that's the intention. And I think the Fed will achieve that. The question again will be, will they overshoot? And based on some of the things that I showed you, it's going to be really hard for them to overshoot. A lot of the economists are saying quarter rate hikes, 6 of them, that's 1.5 points. That brings us to 2%. I mean, that's still historically low. And that's about as high as they can go and still pay debt, the national debt. So the Fed is in a tough place. They can't raise rates as much as they should. They will raise them, but probably to a healthy place, and probably can't overshoot. But again, nobody knows. With the new construction, again, like I said, it is not currently coming close to demand. So I don't see it as a problem. And now, probably the biggest problem is, even with all this new supply coming on, it's expensive. It's really, really expensive. We're in the, we have syndications where we're building new homes, and prices have doubled, literally from our pro forma. We have doubled the price of the homes we're selling. They're still selling like hotcakes. You would think we were making a massive profit. We're not. We are just keeping up with cost. In fact, if anything, we're not making a profit. The investors are doing well, but personally, I'm not making a profit because material costs went up, home prices went up, but it's been delayed. So, I'm concerned that the new product that's coming online is still not what's needed, which is affordable housing. And again, that's where RealWealth has always played a really important role, because we go in and we find that affordable housing and we provide it. And I'm proud of that. I'm proud of you guys for buying that and offering it to tenants and making an affordable home for people. That has always been our focus. And again, we're even able to work with builders who are building at these $200,000, $300,000 price points. It's incredible. They're not making very big profits but they're doing volume, and that's how it works for them. And we help them with that. And they're able, we together are able to provide this affordable housing. But a lot of what's coming online is not affordable. So will it really help with the issue? I don't know. And builders are doing their best, but you have to no one's going to build homes and not make a profit, or build apartments and not make a profit. So they're going to have to raise prices. So I don't know if it's the right supply, but we're doing great work here at RealWealth by working with teams that are able to do that. Question: a lot of my coastal California friends are waiting for a crash. Do you think that's likely in California? Anything is possible, right? But I would say highly unlikely. Highly unlikely, because you have to really look at, again, anything could happen. We just saw an insane war happen that is, it's like we're in medieval times. So coronavirus, like we can't really predict the future. But based on the data that I have and the things that I see, if we don't have any crazy black swan events coming, which we don't know, no. Because if you look at 2008, that was a credit bubble. People were buying homes that they could not afford. And they were doing ridiculous, ridiculous loans where they didn't have to put any money down to buy that house. They couldn't qualify if they were full doc, if they showed what they actually made and what they would never have qualified for those loans. And in some cases, you got money back for buying that house. Stated income loans, it was all just liar loans. So of course, when it came time to pay, people couldn't. It was a different world. It was an insane world. Today, you've got people who have the highest FICO scores ever, who have purchased these homes. They are locked into incredibly low rates. As rates go up, why would you sell your home so you could have another one with a higher rate? You're not going to do that. Why would you not pay your mortgage when you get kicked out of your house and rent's going to be higher? And they're sitting on a tremendous amount of equity. So the people today are locked into low payments with high equity, and they qualified. So how could there be a recession in housing? I just don't see it. If you can help me see what I can't see, I would love to know, but I don't see how there's a possibility that, and in some cases, people paying all cash or putting down huge down payments. So I think if you're waiting for home prices to crash, I had somebody say that 5 years ago at one of my events in San Diego. I had a guy in the front row sitting like this, real grumpy with his arms. He's like, you're wrong. I'm waiting for the crash. And I remember saying, you'll be waiting a while. And he missed out on, he missed out on 5 years of upside and cash flow. So no, I don't see a crash coming at all. But I do see a slowdown in price appreciation potentially because of rates going up. Any danger in investing in areas with a lot of second home buyers? Again, I don't see that as a problem because demand is so high. Of course, if it's a second home, it all depends on the market, how desirable that market is. Let me give you an example that I have something I can speak to directly, which is Park City. We have a development there, a single family home development. During the past 2 years, people realized they could remotely. So Park City's always been a second home place. People started to move into their second homes. They moved into their vacation properties and realized, well, this is cool. I can work from here and ski all the time and enjoy fishing in the summer, and maybe just fly into town when I need to, or mainly work remotely. So actually, a place like Park City is having a terrible time with rental. They don't have any rentals anymore. Obviously, there's some, but so many people moved into their second homes and their vacation homes. So a place like Park City, no. I mean, if anything, they are in desperate need of housing. And oftentimes these vacation areas are limited in what they can build. In Park City, it took our partner 10 years just to get the permits to build because it's a sensitive habitat area. And most places like that are. If you're going to buy anywhere near the beach, you have the border of the ocean, can't expand into the ocean, at least not yet. So these really desirable areas, usually it's hard to bring on new supply because they're, again, environmental restrictions, because they're sensitive habitat areas. So no, I don't really see that, but it depends on the area, like anything. Given that multifamily construction is at a 40-year high, do you feel that it will be overbuilt in some areas in the next few years, especially as interest rates rise, which will likely compress cap rates? Multifamily there's still a desperate need for it. There's still a desperate need for rentals. To me, it has always been a riskier thing. That's just my personal opinion. That's why we don't do a lot of it, but I've missed out on great opportunities for having that mindset. I've just always felt like, boy, if you get a multifamily wrong, you have a bigger loan, you have one asset in one place. When interest rates change, the bank can come back and renegotiate. It's a different deal. Whereas with single family, you're locked in. So I know that there is still tremendous demand for multifamily, and the experts that I do speak with are still bullish. It's just harder and harder to find a deal. We have an underwriter who looks at deals almost every day for us and hasn't found one that will meet our standards, because I'm extremely conservative there, because I've been expecting a shift for a while and I've been wrong. I'm not sure anyone could have seen the way multifamily would take off over the last 2 years. I mean, it's some properties have doubled in value in the last 18 months because there's so much money out there chasing it, and there's still so much money chasing it. And when it really comes down to it, you have to figure, as crazy as this world is, the dollar is still the safe haven, and the United States is still the safe haven. As much as we want to be frustrated with things that are going on and sometimes the management of our country, it is still where investors put their money during times of uncertainty. And when you look at negative rates in Europe, we don't have that. You can buy a 10-year treasury note here and make money. You can buy real estate, and even if it's a 2 or 3 cap, you're still doing better than negative rates, plus the potential for an upside. So there's money coming in from all over the world into the US as a safe haven. So basically, I was on a debate at the Best Ever conference with John Chang of Marcus and Millichap, and we got to be on the same team and talk about where multifamily was headed. And he doesn't think it will necessarily be as robust as last year, but still very, very strong this year. Just not as insane rent growth and price increases the way of last year, but who knows? So at this time, multifamily seems to still be strong. What is your opinion on Airbnb investments? I finally discovered the joys of Airbnb and short-term rentals. It is phenomenal. I cannot believe how lucrative it is if you get the right one in the right place. Rich and I are doing our first, and it's in an area where there's just not enough of them. There's not enough hotels or anything. That's something I'll talk about in a minute. So we have been blown away by the cash flow of Airbnb, but you have to remember that it's taxed differently and it's more active. So there's more cost to it and more time involved, and it's hard sometimes to get the cleaners because of the job situation. You have to pay more now with inflation, but we still found it to be extremely lucrative. I was just on a real estate tour on Monday, and we were looking at what was going on in the area, and so many, not in every market, but in the really hot markets, a lot of multifamily people are buying hotels and converting them into multifamily. So they have to be hotels that are large, have large enough rooms, and maybe already have a kitchenette or something, or there's a certain square footage that they're looking for. But those hotels are being bought up because, of course, the hotel industry got hit so hard that some of them are pretty good price compared to multifamily. So a lot of the multifamily big corporations and syndicators are buying those and converting them to multifamily. Well, what's that do to the hotel market? Takes it off the market. So actually, in those markets, Airbnb is even more valuable. So if you can kind of look at where people are doing this, I know, Phoenix would be one area, Denver, any area where there's a real shortage of affordable housing, and they're doing this. So absolutely, I love Airbnb. You just got to make sure you understand the rules of the area. Long-term versus short-term, like I said, I love them both. Long-term is easier if you have long-term, I think. If you've got it under management, and you just kind of, if you have a good property manager, I prefer long-term investment, and you have better tax advantages to that. However, if you get the right short-term rental properties, it's pretty phenomenal. Are current rent rates sustainable, or should we expect them to drop? No, no, yes, you can expect them to drop. The Federal Reserve is intending on slowing down inflation, and it will happen. It just, how long will it take? It's really a matter of supply and demand. And there's just, again, not enough supply right now for the massive household formation. So it's estimated that rents will still increase this year, just not at the massive double-digit rate that they did last year. But who knows? It could be. It could. I hope not. Like I said, I hope not. It's not good for renters to have to see such massive increases in their housing expense. Would cash out refinancing out of a low rate into a higher rate just to capitalize on the current appreciation, is that a good play? Anticipating many investors may drop off due to high interest rates. If you have a really low, I assume you're talking about your primary residence. If you have a really low interest rate right now on your primary, maybe just look at U.S. Bank or one of the banks that will do equity lines, because then you can keep your low rate but still get some, get an equity line. There are also a lot of lenders out there that there's so much money in lending right now that you might be able to find a good deal without having to get out of your low interest rate. But right now, it's not that bad still. Rates are still not that bad. So if it makes sense with your loan to do a cash out refi and buy some more property, absolutely. Just run the numbers and make sure it really makes sense. Some people are still, maybe locked into a PMI situation. So obviously refining and getting out of that mortgage insurance would be wise, but that would be on your primary. Future of syndications, mainly multifamily investments in increasing interest rate environment. I would just be cautious. If you're going to do any syndications, really have an expert look at the documents. I can't emphasize that enough, that there's a lot of new syndicators who just don't have the experience and have never gone through a down market. I'm not saying we're going to go through a down market, but we are in a changing environment and we don't know what's coming. So it's always nice to do a syndication with a team that has more experience than 10 years, because the last 10 years has just been an up market. So if they have someone on their team with 20, 30 years experience, that would be super helpful. But always, if you're going to do any syndication and invest in anybody else's project, have your attorney, have a real estate attorney review the documents to make sure that you're not gonna, that the syndicator isn't going to just take all the profit through fees. That's one of the ways they do it. They charge all these fees for everything, and there's kind of nothing left for you. Or they're just basing the whole pro forma on the hope that rents will go up. So like I said, we've turned down everything that's come across our desk because it didn't meet our standards. I missed out on some great opportunities, but I was kind of the mindset, hey, you know, sometimes if you're not sure, it's better to not do anything. So again, just have someone make sure you don't just jump into something. For a first-time investor in real estate, what amount do you suggest to start at? I mean, if you don't own your own home, I always suggest that because it's just a 3% down payment, especially if you can get a duplex or a fourplex and rent out the other side or rent out some rooms. That's always a great way to start the whole BRRRR method, or not the BRRRR, the house hacking. I mean, it just depends. The properties that we help investors get into are in the 200,000 range, so that's 40,000 down. But it just depends on the person and how much money you have. So I definitely recommend, if you haven't talked to one of our investment counselors, then you can do that by going to our website and signing up. I have some equity in a few of my properties, but hesitant to cash out refi because inflation could still increase the equity in my properties. The interest rate I would refi to in today's market would be higher than what I currently locked. Yeah, that's an issue. So if there's any way, like I said, that you can just get a second, US Bank is pretty good about that. I don't know about on investment property, but if you have a ton of equity, it still might be worth it to do a refi because rates are still not terrible. You know, they've gone up a lot, but they're still pretty good. And if it's a cheap house, like it's a $100,000 loan, it's not going to make the hugest difference in your payment if you can take a bunch of equity out and go buy some more. So it just depends on the deal. Water issues in Florida and Arizona. I don't know how to answer that, but it's been something I've paid attention to, is water issues, and yeah, it's certainly something to look into, but I don't have the expertise to talk to that, to speak to that. I know that municipalities slow down growth because, you know, you have to have the utilities. You've got to have the water rights. In Colorado, people are selling land and saying, oh, you can build something in Colorado, but it's of no value to you if you don't have the water rights. So, you know, if you're in an area where that's an issue, the existing properties are going to be even more valuable because the municipalities won't allow more building if there's not the water for it. Okay, let's see. Are you worried at all about the institutional money coming and buying a lot of the cash flowing properties? You know, this comes up all the time, that those greedy institutional investors, and you know, they're just ruining everything. But when you really look at it, it's institutional investors are a tiny percentage, less than 5% of what's trading today. So when you look at the 6 million homes that are being sold every year, it's a tiny percentage that's going to institutional. And it's no more than normal. We actually had this discussion inside with our investment counselors at RealWealth, and it's lower than it was 10 years ago in terms of like investor activity. It tends to be around 20% of the homes that are traded, and it's still hovering around that. That includes all of us here. So I forget, we had a graph that we were looking at. Maybe one of my investment counselors can put it in the comments, but I think it was around 23% or something like that. So it's no different than it's really been. And the institutionals are like less than 5% of rentals that are out there. So it's really the mom and pops that own this business, and I hope that it stays that way. That's going to be up to us, right? Okay. What are your thoughts on renting to a family member? I try not to do business with family members. That's my answer. But if the way I look about any kind of transaction with family or friends is the friendship and the relationship is more important. So if I ever lend money to a family member, I'm just going to assume I will never get it back. And as long as that's in my mindset, then I'm fine with it. You know, anyway, if you are ever going to lend money to a family member, in the case of like I've helped family members buy homes, you just put a lien on the property so that you get paid back that way if they ever sell. But having a tenant, it's risky. That's all I can say, unless they just have a perfect track record. Kathy, I enjoy you and your husband and the positive paradigm you share with providing a great service. Thank you. Oh, thank you. Really appreciate that. We often hear about Dallas, Houston, Austin when we talk about Texas markets, but can you please share your thoughts on San Antonio? I love San Antonio. Such a cute city. There's growth there. It's still cheaper than some places. Yeah, you just have to be careful about neighborhoods, just like anywhere. Make sure you really understand. But I've always been a big fan of San Antonio. Houston, love Houston as well. Prices have definitely gone up there, and taxes are pretty high. So we've been really focused more on the Dallas area and the surroundings of Dallas. But if you can find a deal in Houston, that's great. Where can I get a house for 200,000 or so? We, listen to our webinars, talk to an investment counselor, because that's kind of what we've always specialized in. Kathy, we have started to see companies calling employees back into the office and proposing a hybrid work model. Do you foresee that migration, especially from California and New York, to slow down? Yeah, definitely. The cities are filling back up. People are going back to work. But so, you can expect to see some gains in cities in terms of rent and price appreciation, I think. But also, as we see this millennial generation forming families and having kids, it's just not as sexy really to live in a city versus living in the suburbs. So the suburbs are really what seem to be booming, because this model of, yeah, we want you to come into the office, but maybe not every day. You have to come in 2 or 3 times a week. So people are living in the suburbs where they can drive into the office or get into the office, a couple times a week. So those suburbs and even exurbs are really booming. Like, for example, in the Bay Area, I always wondered why Concord wasn't just booming, because BART goes right there, and well, it's booming now. So it's very expensive. So those outer lying areas that maybe never took off as much as the inner city or the central business district, they're booming. When will supply chain issues subside? Oh, let me check in. No, I don't know. Don't know. I keep hearing this year. I do believe a lot of the craziness that we've seen over the last 2 years is temporary, and things are going to settle down. The stimulus, like I said, all this trillions of dollars, it eventually settles. And so, but there's a boom before it does. And that's kind of what I think has been happening. And then because of all that money circulating, businesses were booming and people are hiring and people are buying things and demand is high, and the shipping containers couldn't keep up with it, and all that's going on. But again, I do believe that will subside. I just, I keep hearing by the end of the year, but who knows? Real estate prices are rising as well as mortgage rates, and don't forget about food and gas. At what point will affordability be an issue with everything rising except for wages? Affordability is an issue. It's a terrible issue. When you're out and about and talking to people, they are struggling, they're suffering. Like I said, I was on a real estate tour on Monday and met with some of the managers out there, and they're talking about childcare costs going up, and rents going up, and gas going up, and their managers going, I want to give them a raise, but we've got higher expenses too. So affordability is a terrible issue right now. It's very challenging, and it's not going to get better. So it's really concerning, and I don't know how people are going to get around it. I have been an advocate for 20 years now, trying to get people to buy at least their primary residence. That's one of the things we would talk about within RealWealth, is like, how do we get every single employee to own a property, at least your primary, so you're locked in. If you own a property, you're locked into a 30-year fixed rate, and at least you have your housing expense stabilized. not everybody has that, and it's harder to do now. So I don't know if we're going to see more people, with ADUs in the backyard or sharing, living together. I don't know, but it is already a problem, and it's been a concern, and it's something that was very much visible and known because, like I said, printing money is a secret tax, and it hurts those who are most affected are lower income or median income people. Wealthier people don't feel it as much. So it's a tax on the middle class that they don't even know. And yet oftentimes that group is voting for the people who do more of that, although they all do it. All the politicians are printing money. So anyway, the more we can let people know that printing money is a tax, then maybe we'll lock down on it. Okay. I'm just starting to look into rental investments here in Boston area. People keep telling me to wait until prices go down. Do you think that's going to happen? Would the answer to this question be the same as what you said? I don't think prices are going down. I think price increases will slow down. But in hot markets like Boston, I don't see that particular, unless they're going to bring a bunch of new supply online. But Boston's one of those places that has a border of water. You can't build out into the ocean. It's already built. How are you going to bring on a lot of new supply? So no. And you've got this young millennial group. You've got the colleges there and young people living there. There's a lot of them. There's a lot of them. So I don't know the prices will come down, but they might stabilize. The inventory of homes for sale on Long Island continues to be low, which is driving home values up. A family member is selling a multifamily unit priced at $600,000, which is the same price as a single unit homes on the same street. Does this sound too good to be true? If you can get into a multifamily as a like 4-unit as a primary residence and get an FHA loan or something, you can put very little down and live in 1 unit and rent the rest and kind of live for free, really. That's a wonderful plan. But like any property, you need to do full inspections. When I buy a property, I do every inspection that is possible. I do foundation and roof and just all of it, because that's a negotiating tool. And then you really know what you're getting. So, I don't know if it's a good deal or not, but you can find out by looking at comps and doing lots of inspections. Do you think there'll be a shortage of goods this year? Yep, that's going to be the problem for a while. Any new syndications in the works? Yeah, we're working on some, and I'm sorry it's been so slow. We're really looking for a syndication manager at RealWealth, and we've been interviewing and looking for the person that will help us grow that syndication department. So putting it out there, want to find the right fit. So yes, we want to, and we've got some great ideas on that. With cash flows dropping on our new purchases, maybe going to operating losses versus profits, what conversations should we be having with our CPA? That's a really good question. When I was working with a lot of Australians back in 2010, I was just shocked to find out that their whole model was losses. Like they were specifically buying properties that did not cash flow because those losses really helped them with their taxes. It was kind of an interesting thing in Australia. I may have gotten that wrong, but it was something like that. So, I don't recommend, I grew up in California where people were cash flow negative all the time. That's just normal because they were depending on appreciation, and oftentimes it worked out for them. Again, I don't recommend that. I think in California, you can have a property, put an ADU on it or short-term rental it or whatever, and cash flow on it. So cash flow would really be the key, but certainly run things by your CPA and make sure you have a CPA who understands real estate. So many CPAs don't and are scared of it. So that's not the CPA you want. You want one that's really, really understands it and ideally invest in it. And we have some great referrals for you on our website. My question must have been split up into a couple of messages. You already answered it about coastal California. Okay, good. Okay, do you have any medium-term rentals like medical professionals, or is it better to do long-term? We are working with looking for really good commercial brokers to help our investors who have big 1031s or they want anything other than residential. And one of the things that they have said is really hot right now is the medical offices, but it's also somewhat risky because they tend to be rented by um, groups of doctors who, may split up, or, who knows if they're how their business is going to go. So it's a great investment, can have a little slight higher risk. The lowest risk in commercial would probably be a single tenant, triple net lease type thing. So we're talking to commercial brokers about that too. But right now we don't have that network, but I have definitely heard that medical office, especially the small ones, are a great investment because we know baby boomers are aging and are going to need more medical services, but also healthy and younger than prior generations. So a lot of those medical offices where they're really working on longevity and things like that are going to be hot, hot, hot. If I only have a handful of investment properties, is it advisable to manage them myself? Whew, only if you are thick-skinned. That's all I can say. I am not. So if one of my tenants had a sick child or lost their job, I couldn't. I'm a softie. So for me, it didn't work. I'm much better off having a property manager who really knows how to navigate situations that are sensitive. So it just depends on your ability. I can't do it, but to me, I'm more than happy to pay the 8 or 10% of collected rents to the property manager to handle all of that for me. Would you prefer to buy one property full cash or finance multiple properties? 100% finance. That is how you build wealth. I don't care who, if you're complaining about interest rates going up again, don't do it in front of me because they're still historically low and you're locking in interest rates that are well below inflation. And you're locking it in for 30 years and your cash flows increase. But just don't over leverage. Just make sure you've got plenty of reserves set aside for vacancies and repairs that will be needed. If you're uncomfortable, put 30% down. Instead of the other 70%, now you have extra money to buy more properties, but also to hold in reserves. So I actually think it's much safer to leverage because you also have the sort of built-in asset protection because all cash property, you're kind of left vulnerable if someone sues you, even if it's an LLC. Whereas if there's a loan on there, there's not as much equity for someone to take in a lawsuit. But also, the cash flows are higher and you're locking in low rates. So definitely. Oh, you love the painting of the surfer. This is my daughter Karina painted that for me. Isn't that beautiful? And the other one here, that one, she painted both those for me. I'm glad you noticed. Interesting article today. Gen Z renters lead the rush back to Bay Area cities. Gen Z is not as big. I don't have the slides to show you, but when you look, if you go back to the recording of this, you can look at the generations. And Gen Z is a bit smaller than millennials, but it's still a really large generation. And my youngest daughter is one of them. She's 22. And yeah, they're not ready to buy houses. They're renters and they're going to live in cities and they're what we used to say about millennials, So even though millennials are growing up and having families and moving to the suburbs, you got the Gen Zers who are young and, they're going to live in the city. So yeah, 100%. They're just doing what kids do, living in the cities, having a good time. I did. I lived in San Francisco in my 20s. I wouldn't live there now. Sorry to anyone who lives there. Okay, I missed the webinar. I have one home. You can listen to the recorded one. It'll be up on our website soon. I have one home and rent out the other side Airbnb I just bought last July. I'm considering selling it now and going tiny home. Well, it's a good time to sell. It's a great time to sell. I hope you get a lot of money for it. I apologize if this is what you meant, but when I asked if rental rates will drop, did you mean the rate at which rents are increasing will drop? Yes. Rents are expected to continue to rise as long as there's not enough supply to meet demand, depending on the area. And in areas like Phoenix, where rents were up 25%, in Jacksonville, they were up 25%. That would be terrible if that happened again this year. I hope it doesn't. I hope it slows. And we're expecting, some people are saying it's not going to. I'm hoping it does slow a little bit to maybe rental increases of 8% or something like that. We just don't know, but there's just not enough supply for demand. And there's more and more properties being used for different types of things. So I do think rents will slow. I don't think they're going to drop or decline. This house is a great neighborhood with a pool. Okay. You should be able to sell it. What are your thoughts of some who are blaming investors for low inventory? Again, it's just misinformation. We're still at the same rate that we've always been, around 20% investor activity. It just gets headline news. It's not true. What is your opinion on tokenized real estate? I just don't get it. I did a real estate show on it. I don't know. I'm old fashioned. I don't understand all that stuff. So I just want sticks and bricks. That's all. Oh, thank you. All right, question. Even if for a self-managed property, the rents are not break even to cover the mortgage payments, is it reliable to invest just on appreciation? You know, it just really depends on the property. I'm supposed to say never buy anything that doesn't cash flow, but sometimes you just might find something that's fantastic that you know is going to be desirable, and it might be a little negative cash flow, but it might be worth it. Still don't recommend it. I'd rather see you put it on a short-term rental market or divide it up or find a way to make it cash flow. You know, to me, the key is just to break even. But let's say, you know, you got it for a deal and you're going to fix it up and it's going to be negative cash flow for a little while, but you've got a plan that could make sense. What's your thoughts on putting more down payment to achieve cash flow target? I usually put 25% down, but it's been pretty tough to find cash flowing properties in a good area given the rising interest rates. Yeah, I mean, 25% will get you a better rate too. So again, it just depends on the market. Let me give you an example. I didn't buy properties in Austin because I didn't think they cash flowed enough. And I missed the boat on that one, right? Boise, same thing. So I don't want to, I certainly don't know everything, and I've made lots of mistakes in the past and I haven't been always right. Sorry, I do my best, but you know, somebody could say to me, you know what, I was negative cash flow on my Austin property but it just doubled in price. So obviously playing the appreciation game is riskier, but if you have what it takes and you're willing to take the risk and you really see the growth happening there, by all means do it. But if you're just starting out, I wouldn't do that. You mentioned Concord. How about your thoughts on Antioch and Brentwood? That's been extended. Yeah, absolutely. I mean, all those areas outside of the San Francisco Bay Area are growing like crazy because finally people on the peninsula are realizing it exists. I grew up on the peninsula and I could barely get my family to come visit me in Walnut Creek because it was just so far away. But what they didn't realize is I had BART and they didn't, and I could get in the city in 20 minutes and they had to deal with traffic. So I think people in the high-priced peninsula are realizing that there's this East Bay that's beautiful and has BART. So yeah, I think there's still an upside there given what's going on in the peninsula and in San Francisco. But again, it just comes down to the numbers. How can you compete with multiple offers, especially if they ask you to waive inspection or pay appraisal? I will never waive inspection. I won't. But if you have the ability to really walk through it and you can look at it like an inspector would, then you might be okay. I know people are buying without inspection and appraisals all the time. It's risky, super risky. Rich and I bought a house that we actually had inspected and we ended up finding all kinds of issues with it later. So older homes, you know, they can come with issues, and sometimes, you know, you just go, okay, it may need new electrical, it may need this and that, and you just kind of put that into it. But I wouldn't get caught up in the frenzy unless you really just need a place to live. Like my daughter really just needed a place to live. She's got a baby and a husband and 2 dogs, and rents are insane. So they bought a house where the electrical needs to be replaced, you know. So they bought it anyway, and they're just going to have to replace it someday, but they have a place to live. But if it's an investment property, I don't know. Get your inspection. Who could I talk to on your team regarding potential listings like what you just described? Have an off-market medical 30 minutes outside of Austin. if you're going to talk to our investment team about properties we don't know about, we won't be able to help you. We're not licensed in those areas. If you're saying you want to sell it, I mean, definitely talk to a local broker about something that, we don't have somebody in Austin right now that can help you with that, but there's lots of really good agents who can. But if you want to talk to our investment counselors about properties within our network, you can just go to realwealth.com and join if you haven't already, and book a time with an investment counselor. Okay, is this hot seller's market? Do you advise to waive inspection? Nope, 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 nope. I know people are, my niece sells property in the peninsula south of San Francisco, or in San Francisco too, and she said people are not doing, they can't. The offers are coming in, no contingencies, no inspections, and I respect that. Again, if you need a place to live and you have the money and you can fix stuff that you don't know is as a problem, then that's fine. And there's so much money in the Silicon Valley that people might have an extra $1 million to just repair a house and they just want the land. That's fine. But if you're not the multimillionaire, then just be careful of no inspections. You could just end up with a real dog that costs you hundreds of thousands of dollars, if not more, because you don't know what's wrong with it. So I don't like buying without inspections, but I understand sometimes that's your only choice. Just be careful. Okay, the high growth area cap rate is so low that you can't have positive leverage. Sorry, I wasn't sure which area you were talking about. What do you think about the East Coast market, such as Maryland? Do you think the supply is increased? I see a lot of building under construction. We're staying out of the high-priced markets that are not very investor friendly. So that would be Maryland to me, but I have relatives that live in Maryland and they might think differently. That's just not a market that we know very well. But I imagine, well, actually, I take that back. We've got a great team in Baltimore. So just depends on the area and the cash flow that you're getting there. But really, it's across the country. Across the country, there is a shortage of homes and great demand. It's unprecedented. Even areas that have never seen appreciation, like Cincinnati, they're having the same issues. And in fact, places like Cincinnati, they haven't had all the builders coming in and the national builders bringing in new supply, because a lot of those builders are focused on Atlanta and Phoenix and Dallas and Houston. And so some of these areas that have always been sort of flat markets that didn't appreciate very much, they're starting to see that appreciation. So it's just across the board. Okay, I'm gonna kind of start to wrap this up. Oh my gosh, we're at an hour and a half. Thanks for staying with me here. And do just a couple more. What would be the reasonable cash flow? Let's say invest in a house of $500,000, interest rate 3.5%. How much is considered reasonable? Oh, that's a really good question. I think a lot of people are settling on a $500,000 house. You're gonna be lucky if you get 6% return, maybe 5%. We're sticking in the, well, unless it's in an Airbnb, that would be a different story. I know some of the Florida teams are selling homes in the $500,000 range, but doing a short-term rental, and it's been really lucrative. Generally, again, depending on the area, there won't be a ton of cash flow. Most likely, we sort of stay in the $200,000 to $300,000 range for rental properties. But again, depends on the area, and rents have gone up, so it could actually work out. We'd have to see the pro forma. Thank you for saying that you will never waive inspection. I have been under pressure to waive it. I know, not in RealWealth. If anybody in RealWealth Network tells you not to get an inspection, you make sure I know about it, because that is not acceptable. You must get an inspection, especially if you're buying a property you haven't seen, and you have to have a third-party person walk that for you. But I know that there's super hot markets like Dallas and, again, San Francisco, where, hey, not enough properties, there's lots of buyers, so the buyer who's going to buy it with no inspection gets it. That's how it is. So you just have to have enough money and tolerance to buy that property and know that you may have to fix a bunch of things. Any thoughts on using Delaware statutory trusts in lieu of 1031 exchanges? Yeah, the DST is an option for a 1031 exchange. We don't have any DSTs we can recommend at this time, but that is a way of investing in a fund with a 1031. Kathy, on the off-market medical, I'm a commercial broker. Oh, good. Reach out to us. Love to talk to you. You can do info@realwealth.com. Inspection and bank appraisal. Heck yeah, do them both. If you're getting a loan, then you'll obviously get an appraisal. The bank will force it. But if you're buying all cash, you should still get one. Okay. Oh my gosh, we made it through all the questions. Take care, everybody. Thank you so much. And we'll see you soon next time. Bye-bye.